All right, welcome back. Now we're going to continue our discussion about liabilities with a introduction to working capital. Working capital is our current assets minus our current liabilities. So it's kind of similar to the current ratio, except this is in an absolute number as opposed to a ratio. So the working capital is a measure of the company's liquidity because we want to see more current assets than current liabilities. That's the excess money that we have to run the business. If our current assets equal our current liabilities, we have no working capital, which means all we can do is pay our debts. We can't do anything else, and that isn't what we want to see. So the working capital is an indicator of the health and profitability of the company, because as working capital goes up, it means we have more money to play with to grow the business and improve it over time. So changes in working capital are important because they have a direct impact on the cash flows of the business, specifically related to the operating activities. So many working capital accounts have a direct relationship with income producing activities. For example, if we sell something on account, that increases our receivables. If we pay for something on account, that would increase our payables. Account receivables a current asset, account payables a current liability, so they both affect the working capital. The working capital accounts, any account that affects working capital is going to impact cash flows from operations. Don't worry about this at this point in the course. We're going to cover it in our last chapter when we discuss how to create a cash flow statement. But all you should understand is what I've taught you from the beginning, which is any cash flow related to earning revenue or using expenses would show up in the operating section of our cash flow statement. You should also understand that we want a high working capital because that provides us with more money to run the business, to do something beyond just paying our debts. Long-term liabilities, we've talked about no payable. Any long-term liability is an obligation that we owe in more than a year. No payable is one example. Another is a bond payable. We have a whole chapter 10, dedicated to bonds payable. Bonds payable is just another way for a company to get money. We'll talk more about it in the next chapter. With long-term liabilities, there's two general types. One type is secured debt, which is when you have some type of collateral. So I have a house and I have a loan on the house called a mortgage. And what that means is if I don't pay my mortgage balance, if I don't pay my payments, the bank can come in and take my house. They can repossess my house. So the loan is secured by my house. So if I don't pay, the bank won't lose money. They can take my house over and sell it, and then they would get all their money back. Unsecured debt is when the lender relies simply on the borrower's integrity. And it's much more risky from the bank's perspective, because in an unsecured debt situation, if I don't pay my debt, then the bank has no recourse. They have no assets that they can seize to make themselves whole again. Long-term note payable and bonds are important to a company because it's one of the major ways that they can get themselves capital, their assets. Remember, they can get it from investors and they can get it from borrowing money. So a lot of times companies raise capital by borrowing money from either banks or insurance companies or pension plans. And when they need more capital than a single creditor can provide, the company may issue publicly traded bonds to the public. So basically what a bond is if you take out $100 million, one bank may not want to lend one company that amount of money because it puts a lot of risk in that one company. So what we can do is take a $100 million loan, chip it up, cut it up into smaller pieces, and those pieces are called bonds, and then they can be sold to multiple different people. Another example that you might be familiar with would be U.S. savings bonds. If you ever got one of those from grandma or grandpa, you got excited thinking you got $50, but in reality, you can only get the $50 if you waited 20 years to turn it in. That is an example of a bond payable. The government is the one that has the payable. They took the trillions of dollars they need. in loans and chopped it up into little pieces, and that's what a savings bond is. So when a company needs a whole lot of money, one way they can do it is to create bonds payable and get that money from a whole lot of different people. An example I'd give in the classroom is I'd ask how many of you would lend me $100, and usually one or two people raise their hands, sometimes nobody, and that's mostly because students wouldn't want to lose $100 if I didn't pay them back, or students just don't have $100. Then I ask how many of you would lend me $1, and almost everybody in the classroom raises their hand. So though it might be hard for me to get $100 from one person, I could get $1 from 100 people and still have the amount of money I need. That's really what a bond is. It's taking the total amount that you need and chopping it up into a bunch of small pieces. And as I've already mentioned, we have a whole chapter dedicated to bonds and how they're recorded. So you don't need to worry about that at this point. Chapter 10 will cover that.